talk about insurance so one day you can own a home. Yeah, at least you're prepared for when you do own a home. Okay, let's say you're in the market for homeowners insurance with your new house. You want to make sure that your property is protected in case of unforeseen events like fires, storm, or theft. You start shopping around for insurance policies. Now, insurance companies often standardize policies, which means you follow the same rules and terms across different areas. This standardization is sometimes required by law in certain states, so you don't have much flexibility in choosing the specifics of your policy. You can either accept the offered policy or go without insurance, which isn't a great option when you want to protect your valuable assets. Yes. To find a policy that fits your needs, you make an offer to the insurance company by submitting your application and paying the premium. The contract is formed when the insurance company accepts your offer, usually by processing your payment. Sometimes the insurance company might make a counter offer with different terms. You have the choice to accept or reject. So negotiate, babies, you got this. Now, here's where things get a little spicy. To get insurance, you need to have what's called insurable interest in your property. This means you have to have a financial or factual connection to the property that justifies insuring it. For example, if your house burned down, you suffer a direct loss because you have a financial stake in the property. Now, when it comes to the type of policy you choose, it can affect how much you get paid in the event of a loss. Value policy covers the full agreed upon value of your property, regardless of the actual market value. If your house is insured for $300,000 and it's completely destroyed, the insurance company has to pay you that full amount. On the other hand, we have an open policy, which covers the fair market value of your property at the time of the loss. So if your house is insured for its market value of $300,000 and it's destroyed, and the insurance company will pay you the fair market value of the house prior to the loss. Just a heads up, fair market value just means what the market values your house at. So let's say that I bought this water bottle for $20. Now that I've had it for a year, it's only worth $3. The insurance company would only insure me the $3 should I break or destroy my beautiful water bottle of mushrooms. Understanding these types of policies and the basics of insurance contracts can help you make informed decisions when protecting your assets and ensuring you're properly covered in the case of emergencies. Now let's kind of just go over what we talked about. So there are multiple types of policies within insurance. Insurance policies are like contracts, and insurance companies often standardized policies, especially since they operate across large areas. In some states, these standardized policies might be required by law, giving you limited options. You might have to accept what's offered or go without insurance, which isn't ideal. Offering acceptance within insurance. When you want insurance, you make an offer to the insurance company by filling out an application and paying a premium. The contract is formed when the insurance company accepts your offer, usually by processing the payment. Sometimes they might offer different terms, which you can accept or decline. Agents can often make insurance effective immediately with a temporary contract called a binder, but oral contracts are rare. Oral contracts meaning spoken, not written down. Insurable interest. This means you have a stake in something that could be damaged, like your house. Insurance is something meant to protect you against potential losses, not to make a profit. Types of policies. Now, there's a valued policy and an open policy. A valued policy covers the full amount of the property as agreed upon when the policy is issued. If there is a total loss, the insurer must pay this amount, not the actual market value. Open policy, on the other hand, covers the fair market value of the property at the time of the loss. If there's a total loss, the insurer will only pay you the fair value prior to the loss. The nature of insurance contracts. Insurance contracts follow the general contract law principles. You must have financial or factual connection to the property that you're insuring, known as insurable interest. And of course, you have to pay premiums for the insurance policy. There you have it, keys.